Meantime, S&P NASDAQ on pace for their best month since November of 23 after that court did strike down the president's worldwide reciprocal tariffs last night and ordered the administration to stop collecting them. Joining us this morning, Jeremy Siegel, professor emeritus of finance at the University of Pennsylvania's Wharton School of Business, of course, chief economist at WisdomTree. Professor, good morning. Good to see you.
Good to see you, Carl.
So Carney of Canada, already on the tape, welcomes the U.S. court ruling on tariffs. What do you think this does to the picture, the cadence of would-be trade talks? Does it actually make the picture brighter or more cloudy?
Well, honestly, I think the market had already anticipated that we're not going to get back to those reciprocal tariffs of April 2nd. We're not going to get back at all to those 100% plus tariffs of China. I think they had already written those off, or the 50% plus tariffs that he threatened to impose on Europe. So in a way, I don't think it changes that picture that much. We do know there are some alternative routes that the administration can take to put some more tariffs on if it needs to. Honestly, I think that you would not get the market bounce back unless the market I believe it can live with a 10% base tariff, maybe 30% on China. I'm not quite sure how that might be threatened by the current level. I think they could get to that level. They could live with that. So they're looking beyond that, and they're looking to what is the economy beyond super high tariffs to moderate tariffs. And I think they like what they see. I mean, look what's gone on with AI, the promise of AI and NVIDIA, back to the level of, I think, the day before DeepSeek, which, was supposed to be the beginning of the end of the company. But the demand is there, and not only the demand, but the promise, and this is very important, that could boost productivity for our future American economy enough to mitigate the deficit, because we know growth is really the major way that we get out of our deficit problems. And if we can raise our growth from 2% to 3%, which is not unreasonable, our deficit problem becomes an awful lot less threatening.
Right. I do wonder, some asked last night whether or not you can count on $2 trillion in tariff revenue now, and whether or not these tax bills need to be rescored, and what that might do to vigilantes at the long end of the curve.
Really, most of us who looked at it didn't think there was enough there in tax revenue, to really cause any really change in the long-term deficit. In fact, most of us thought that the drag of those taxes would actually lower the revenue on the other side by almost as much as they would gain on this side. So I don't think that the net of less tax revenue from the tariffs is important. Many economists argue about whether we should rely less on the income tax system, which is what the Trump administration wants, go to a more broad-based tax, not just the tariff tax, but something like a value-added tax. But clearly that's not in the agenda of Congress right now. It was a kind of a baby step towards it. Let's have tariffs the way the Europeans have value-added tariffs. But I don't think we're going to get there. So basically, I think the tariff is a wash with the growth, and we just have to look at what the deficit is going forward. Yes, it has to be brought down, and hopefully AI will help us bring it down, in addition to legislative proposals.